inflationary period we've had, you see people, catch up over a period of time, but it doesn't happen immediately. Now, maybe a positive I can share with you is that we did, we do contact calls, and this was larger firms. What we're hearing is that they're still working on catch up for their workers, and so they recognize their workers fell behind in real wages. And so you ask, before the most recent wage data came out, you might ask, why do firms in a softer labor market, a slowing labor market, keep raising wages at, say, the average is around 3%? Why do they keep doing that? It's because they want to give a little catch up, right? And they want to make sure that their workers feel confident that they didn't get completely left behind in that. And that's how the labor market typically works. So that's what's happening now.
I know we're out of time. Do we have time for one more question? One more question. Thank you. All right, Carl.
I'm not sure you won't mind then. Carl Bonham, Executive Director at UHERO. And I just had you mentioned earlier that the inflation expectations were anchored.
Yes.
Which was impressive throughout this episode of inflation. But it makes me wonder why we haven't cut yet. And I'm not latching on to the last labor market report or anything like that, but we clearly have a labor market that is slowing, maybe weakening, and I mean, the trends are largely all towards continued weakening. Hopefully that's going to flatten out at some point, but there's no real evidence of that. At the same time, we've got these anchored expectations. We know there's a lag between monetary policy, even as market rates move by themselves. And I would argue that we've already achieved the inflation goal. You mentioned the 2.6% headline CPE. If you take out OER, you're at 2%. And I'm curious whether you think we should take out OER, maybe before the next cycle. And then I'll finish with one question. I wonder what your view is of the neutral rate, because my guess is that we're going to have restrictive monetary policy all the way through next year, unless we see some really big cuts.
I feel like I've been given a test when you teach. So, okay, I can do it. So, so let's go to the policy rate and the economy. So, right now there's a difference between the level of activity and then projections about where you think it might go. We have a lot of clarity over the level of activity, which is how strong is the demand for workers, how strong is consumer demand, how good are incomes, all the things that we can talk about. And when you talk to businesses, they don't think that their business is weak, they just see it slowing. So then you get into, okay, what is the projection? But there we have considerable uncertainty. Now there's always uncertainty about the projection, but the uncertainty that we've been facing is even wider because we got that poor data on inflation earlier in the year, and that was when the talk emerged that maybe policy is not tight enough. Now I was never a proponent of that. It always seemed completely tight enough and very restrictive to me, but there was a lot of chatter about that. So that has passed. As I said, that's over. Now we're to a point about, is the labor market slowing a lot or slowing a little? As you see from the projections for the employment report, it did not have this. That's why everybody's surprised. But it also hadn't factored in Hurricane Beryl to the extent that disrupted activity, and didn't factor in the growth in the labor force, which was largely due to the inflow of immigration. So those are things that you don't know. So what is important though, and I'd say this is even more important than is it July or is it September, what's really important is, has the economy downshifted and did we recognize it? And if you look back at the FOMC statement and Chair Powell's press conference, you see the statement indicated we see it, and that Chair Powell indicated we recognize it, and that we're prepared to act as we get more information. And that is in part, I believe, why you see the labor market report translating into rate reductions of mortgage interest rates and other things, right? Is because they understand our reaction function, that we do, that it's clear inflation's coming down closer to our target. It's clear that the labor market is slowing, and it's to a point where we have to balance those goals. I remember I gave this talk in June a speech at the Commonwealth Club in San Francisco, and I said, elevated inflation is no longer the only risk we face. And that got a lot of attention in the room, and in part it was because there was a sense that, yes, we've arrived at a place where inflation is now, I'm more confident that we're on a sustainable path to 2, and that labor market has to come back into frame. And that's why I said earlier, that itself, the communication itself, is a policy adjustment. And if you act when you don't know more, because with all this uncertainty, you can actually end up making a mistake. And it is just as, up until now, when you see that there could be potential weakness in the labor market, although I don't see it yet, really the risks they were just becoming balanced, right? The risk, because you don't want to leave inflation persistently above 2%. That would be, people have endured this interest rate environment just to leave inflation at 2.6. That's not a good outcome. And we don't want to tip the labor market over. So that's the world we're in right now. And as I said, it was a unanimous decision to leave it. And the communication that we do is, in my judgment, equally valuable.
All right, well, President Daly, thank you so much for taking time out of your schedule to join us here this morning. We know you have a busy schedule here, a short time in Hawaii, hopefully get to do some relaxing and a little bit of vacation while you're out here, but we appreciate you. And thank you all for being part of this conversation. And again, thank you to Hawaii Executive Collaborative for helping to organize and have us here today. Thank you all so much, and enjoy the rest of your day.
Thank you.
Aloha.
Thank you very much.